You know, when you think of Warren Buffett, you probably think of billions of dollars. But his real genius, his secret sauce, it isn't some complicated stop-picking formula. It's actually a powerful mental framework for making rational decisions in a world that is anything but. So, let's dive into this toolkit for thinking clearly. This quote right here, it just nails the core problem every single investor faces. See, we're not dealing with some cold, calculating machine. We're dealing with a patient that is, well, emotionally unstable, swinging wildly between total euphoria and absolute despair. To really bring this idea to life, Buffett's mentor, Benjamin Graham, came up with this brilliant little story. Imagine you have a business partner. His name is Mr. Market. And let's just say he's moody. Every single day, he shows up at your door and offers to either buy your shares or sell you his. But the price he quotes has nothing to do with the real value of the business. Nope, it's based entirely on his wild emotional state that day. I mean, some days, Mr. Market is in a complete and utter panic. Take October 27th, 1997. He was so freaked out that the Dow Jones Industrial Average just plunged over 7% in one day. And then, get this, the very next day, total euphoria. He completely changed his mind, and prices surged back up by almost 5%. Did the fundamental value of America's biggest companies change that dramatically overnight? Of course not. It was just Mr. Market having one of his wild mood swings. All this daily noise from Mr. Market, it creates what you might call the Q culture. It's an obsession with the price quotes flashing across the screen. The ticker tape becomes this addictive game, and people completely forget that they're supposed to be buying a piece of an actual, real-life business. They're just reacting to Mr. Market's latest fit of mania. So how on earth are you supposed to win a game that seems totally rigged by emotion? Well, this is where Warren Buffett, learning from his mentor, flips the whole thing on its head. You don't play Mr. Market's game. You play a completely different one.
And this whole philosophy, it comes straight from Benjamin Graham, the father of value investing, to his star student here. Graham's big insight was that the market's chaos isn't a risk to be terrified of. For a rational person, it's actually an opportunity to be seized.
And this is the secret, the huge mindset shift. Stop trying to predict Mr. Market's moods. You can't. It's a fool's errand. Instead, you treat his emotional problems as a service. When he's panicking and offering you great businesses at ridiculously low prices, you buy. And when he's deliriously happy and offering you absurdly high prices, you can sell. You use his irrationality to your advantage. So how does he do it? Well, Buffett uses this really simple but honestly profound three-part toolkit. And these aren't complex financial formulas. They are mental models, ways of thinking designed to keep you sane while everyone else is going crazy. Okay, so what's in the toolkit? It comes down to three core ideas. First, you have to know your circle of competence. Second, you have to understand the huge difference between value and price. And third, you must always demand a margin of safety. Let's break each of these down.
All right, pillar number 1, the circle of competence. This is all about intellectual honesty. It means you don't have to be an expert on thousands of companies. You just have to know the actual perimeter of what you do understand and have the discipline to stay inside it. If you can't explain to a 10-year-old how a business makes money, you really have no business owning it.
And as Buffett himself says, the size of your circle really doesn't matter. What's vital, what's everything, is knowing exactly where the edge is. That discipline is what stops you from gambling on the hot new thing you don't actually understand, which, let's be honest, is where most people make their biggest mistakes. Now for the second pillar, and this might just be the most important one of all. It's the ability to see the massive gulf between the price of something and its actual value. This right here is the core distinction. Price, that's what Mr. Market is screaming at you all day long. It's just a quotation, and it's driven by emotion, by fear, by greed. Value, on the other hand, that's what the business is actually worth. It's a logical, analytical concept tied to the real cash it's going to produce in the future. They are not the same thing. And Buffett defines this intrinsic value with cold, hard logic. It's not a guess, it's not a hope. It's an estimate of all the cash that a business can give to its owners from today until the day it closes up shop. It all comes down to this. Price is what you pay. Value is what you get. Your job is to get way more value than the price you pay for it. Okay, and that brings us to the third and final pillar. This is your ultimate defense, your safety net. The margin of safety. It's a simple idea. Once you've estimated what a business is worth, you only buy it for a lot less than that. It's the buffer that protects you when your calculations are a little off. Because trust me, sometimes they will be. Buffett has this brilliant analogy for it. You wouldn't build a bridge that can only just hold the weight of the trucks, right? No! You'd over-engineer it, just in case. You build it to hold 3 times the weight. Investing should be exactly the same. If you think a stock is worth $1, you don't pay 98 cents. You wait for Mr. Market to have a breakdown and offer it to you for 50 or 60 cents. That gap, that's your margin of safety. So when you put all 3 of these pillars together, your circle of competence, focusing on value over price, and demanding a margin of safety, it does something incredible. It's more than just a strategy. It fundamentally rewires your entire mindset. You stop being a market analyst who's trying to guess squiggly lines on a chart, and you become a business analyst who's trying to understand how a company actually works. Suddenly, a market crash isn't a crisis, it's a clearance sale. You focus your energy on just a few things you know really well, you always build in a cushion for being wrong, and maybe most importantly, you learn to think for yourself instead of following the herd. And here's the thing, this goes way beyond just stocks. This is a framework for making rational decisions, period. So I'll leave you with this question. Outside of your finances, where else in your life, in your career, in big projects, even in relationships, could building in a margin of safety be the one thing that protects you from a really bad outcome?